What does the Middle East crisis mean for global trade? Before the conflict escalation, global trade was already facing headwinds from tariffs, weakening demand, and rising geopolitical tensions. The escalation in the Middle East introduces, therefore, a new layer of disruption, particularly through higher energy prices, supply chain risks, and financial uncertainty. That's why we now expect a slower global GDP growth at 2.6% in 2026, a higher global inflation at 4.3%, and increased pressure on corporate margins. Global trade is likely to slow down to just 1.5% this year, after close to 4% last year. But despite this challenging environment, actually companies show quite a high resilience. According to our 5th edition of our Allianz Trade Global Survey, of 6,000 companies worldwide, 75% of exporters still expect a positive export growth in 2026, with the majority anticipating a moderate growth into the range of 2% to 5%. However, risks are clearly rising. Geopolitical and political risks are now the top concern for 65% of firms, while 60% are worried about logistics, disruptions, and rising energy costs. We're also seeing tighter financial conditions. Payment delays are increasing, and 40% of firms expect higher non-payment risk in an environment where global business insolvencies were already expected to continue rising in 2026. A key risk is the Strait of Hormuz, of course. While only 2% of global trade is currently actually fully disrupted, a prolonged blockage could significantly worsen the outlook and even trigger a trade recession. Let's not forget that before the conflict, around 40% of trade was already under some form of friction because of the US trade war, or because of export restrictions or bans, or some reduced maritime capacity, if we think about the Suez Canal or the Red Sea or even the Panama Canal. What companies need to pay special attention to in this case is that even in a case of a ceasefire, a reopening of the Strait of Hormuz would be gradual. Security risks tend to ease more slowly than physical disruptions, meaning that trade flows, and especially oil, would likely recover in stages, starting at only 15 to 30% of normal capacity, before, of course, scaling up cautiously. Historical precedence shows that the full normalization can take weeks or even months. So overall, the Middle East conflict matters for global trade, and not just because it stops it, but because it amplifies existing vulnerabilities. It raises costs, increases risks, and accelerates the need for companies to rethink how, and especially where, they trade.